This video is sponsored by Squarespace. Go to squarespace.com/ThePlainBagel to save 10% off your first purchase of a website or domain using code ThePlainBagel. Tesla is a heavily debated stock in the investment community. On the one hand, it has a history of missing production targets, has only recently been earning a profit, and CEO Elon Musk's Twitter account has gotten him in hot water at times. On the other hand, it's the poster boy of electric vehicles, a product facing secular trends, and its stock has seen astronomical returns, rising 50% over just a few days this January, and seeing a total return of over 4,000% since going public in 2010. The incredible return has drawn a lot of attention to the stock, but is the stock's performance supported by its fundamentals? In other words, is buying Tesla stock investing or speculating? It's an important question we need to ask ourselves whenever we buy a stock, because when times are good, the line between the two gets a little blurry. So let's address what it means to speculate and how to make sure you aren't gambling your money on today's Plain Bagel. As you probably saw, we recently posted a video on the .com bubble, one of the most well-known examples of a speculation-fueled crash. So it always seemed fitting to dive into what makes something speculative. After all, hindsight is 2020, and while it's easy enough to think, yeah, we shouldn't buy speculative companies, it can be hard to identify what counts as speculative in the current environment. After all, there isn't any technical measure we can use to determine whether something is speculative. And in fact, there are plenty of stocks, like Tesla, that people disagree on. Some believe it's a speculative business with a lot of risk, others that it's a solid company. Not to mention, you can technically speculate with any investment. After all, the term speculate just means to form a theory or conjecture about a subject without firm evidence. So buying a stock just because it's gone up in price or without understanding its business counts as speculating. But today, we'll focus on what specifically makes a company speculative in nature, so that you can make sure that when it comes to your finances, you aren't rolling the dice with your portfolio and taking on too much risk. So let's start with what it actually means to invest. An investment, as you probably know by now, is an asset that we purchase with the goal of generating some benefit. Everything from your first car to your education can be considered an investment, since these things provide a benefit of sorts when you purchase them. But for stocks, the benefit we're talking about is financial, in the way of dividends or price appreciation. Now, this basic definition of investing also seems to apply to speculation. After all, no one buys a stock unless they expect it to go up in price. But the real point of differentiation revolves around the risk one takes on when they buy a certain stock. When we invest in a stock, we are generally looking to buy a company with a solid track record that offers an appropriate return with not too much risk. Speculative investments, on the other hand, face a high probability of losing a lot of money, while simultaneously offering seemingly high returns, which is why many people equate speculating to gambling. The payoffs can be mesmerizing, but the downside is very real. This is why companies with low credit ratings and deteriorating operations like General Electric can end up being classified as speculative even after operating a solid business for many years. Since they now face a high risk of going bankrupt, there's a higher than normal probability that the investors will lose the money they've invested in the firm. But if the company happens to turn around, it can be a big payoff. Now, obviously, Tesla isn't like General Electric. It's currently seeing massive sales growth, and while it checks the box for high stock returns, people may disagree as to whether the position is risky. But while the firm may not look poised to go bankrupt, for example, there's still a risk when it comes to the gap between its current operations and what it is expected or hoping to achieve in the future. We'll explain this further with an example. Imagine you are looking to invest in one of two mom and pop stores. The first is one that's been in operation for 20 years, has experienced solid growth, and earns a nice profit after costs. The second one, on the other hand, has only been up and running for about a year and has lost quite a bit of money in that time. Thing is, it's selling a new trendy product that the first one isn't, and management believes that the store will increase sales tenfold and be profitable in 3 years' time. Clearly, there's a big gap between the store's current operations and what it hopes to achieve in the future, meaning there are a lot of unknowns and risks. Perhaps it will come out that the new product they're selling causes severe health side effects, or maybe the demand won't be as strong as anticipated. With a short track record and high expectations, the second store is a lot more speculative than the first. This is why many startups, especially those operating in new industries, are classified as speculative until they further develop themselves. Compared to a mature company, they face a lot of unknowns that could prove detrimental to their operations. Tesla, of course, faces a lot of uncertainty. Its production line is still being developed, it's just recently been earning a profit, and who knows how competition will affect the company in the future. But of course, the company does have its merits. Electric vehicles are expected to continue growing their market share, and Tesla's product is seen as one of the best in the space. So some are reluctant to call the company speculative. But even if a company is more than likely to grow earnings, it can still be a speculative investment if its stock price is too high, which, if you've been watching Tesla, is certainly something to consider. After all, the price we pay for a stock needs to be grounded in its fundamentals, like how much money it actually makes, or the assets it owns, or how much it's expected to make in the near term. In our mom and pop store example, if the first store is consistently generating $1 million in annual profits, you'd want to pay a fair price for it. Perhaps you'd be willing to pay 10 times earnings, or $10 million, since you'll get your money back in 10 years' time, even if earnings don't grow. But when companies like our second store are losing money or have yet to prove their profitability, the same principle is hard to apply, since investors have little more than management's expectations to base estimates off of. Sometimes these estimates will be reasonable, possibly making for an attractive investment. But when investors are looking for a company to double, triple, quadruple operations, the loftier expectations can lead to an excessively high stock price. In fact, a stock price may at times disconnect completely from fundamentals as people hop on the bandwagon and push prices higher. And when you stop and compare what people expect from a company to what it's currently doing, you may find the price is based on little more than the brightest aspirations, like we saw during the dot-com bubble, which leaves a lot of room for future operations to disappoint. Even if the second store achieves earnings growth of, say, 5%, it could still see a sharp decline in its theoretical stock if investors were hoping for operations to increase 2 or 3-fold. So even if a company has solid operations and is expected to grow, it can be speculative if its stock prices in exuberant expectations. And when it comes to Tesla, this is something to consider. Currently, the company has a forward price to earnings multiple of 74.3 times, meaning that the company's stock is selling for 74 times its expected earnings for next year. This compares to the S&P 500's average of 18.5 times. Now, sure, the company looks poised to grow faster than the S&P 500, and you typically pay more for higher growth companies. But with a valuation larger than Ford and GM combined, it certainly looks to be in speculative territory. But before we start blowing up my comments section, I'll go ahead and say that just because something is speculative doesn't mean it won't do well. Tesla has an awesome product, and there's of course a chance Tesla's fundamentals will eventually catch up to its price. Amazon and eBay are two companies that were born in the dot-com bubble that went on to surpass expectations, despite certainly being more speculative at inception. I've also only done a service level dive into Tesla. If you've done your own research and decide you want to own Tesla, by all means, that's your prerogative. But don't ignore the risks that come with a speculative holding. Nothing is guaranteed in investments. And while we've had a fantastic few years, we don't know how companies like Tesla will fare in a downturn. In 2001, the US entered a recession, and by 2004, half of dot-com companies created during the internet bubble failed. That despite the technology literally changing life as we knew it. So if you want to buy speculative assets, whether it be risky stocks, cryptocurrencies, or options, make sure you limit your risk to what's appropriate given your financial situation and what you can afford to lose. In the same way you wouldn't, hopefully, put all your life savings on a hand of blackjack, you shouldn't likewise invest everything in speculative assets. And hey, maybe you'll miss out on the next Amazon, or wish you had put more money into one of your bets. But you don't want to put your financial well-being at risk. And by being prudent, you'll also miss out on the next pets.com, or the next boo.com, or the next webvan, or you get my point. Thanks for watching. If you like this video, make sure to hit the like button. And if you like what we're doing here, make sure to subscribe. Hit the bell icon if you want notifications about future videos. If you have any feedback or topics you want me to cover in a future video, leave a comment down below. For The Plain Bagel, my name is Richard Coffin. Thanks for joining me today. This video is sponsored by Squarespace. As I'm sure you know, building a website is an important part of increasing your searchability while giving people a resource to learn about you, your business, or your hobby. And while getting started may seem like a tall task, it's really easy with Squarespace. I recently put out my own website with them, and their builder was really intuitive. There are page templates that make it easy to add features to your site, and embedding videos is a cinch, making it really great for content creators like myself. But if you're looking to sell a product or build a resume, Squarespace has got you covered too. They even have appointment scheduling and email campaign tools to help you manage your business and keep your followers up to date. Oh, and the best part, you can try their page builder for free, so there's no risk in seeing what you can put together. And if you love it, you can use coupon code THEPLAINBAGEL to get 10% off your first purchase of a website or domain. Just use the link in the description to show them I sent you their way. So if you're looking to get your name, brand, or business out there, I highly recommend you check out Squarespace.